Ever feel like you're just drowning in crypto news? One headline pops up, then another, charts flying everywhere, different experts saying completely opposite things. It's a lot. You end up seeing all the little pieces, but completely missing the big picture.
Oh, absolutely. It's information overload, pure and simple. And it can feel paralyzing, honestly. That's really why we do this deep dive. It's not just about reporting the what. We want to help you actually understand the why,
Mm,
connect those dots that get lost in the noise.
exactly. And that's our mission today. We're going to slice through all that clutter surrounding some, well, pretty significant recent moves in the crypto market.
Right.
Think of this as your guide, helping you get genuinely informed, using insights from analysts who live and breathe this stuff. We've pulled together market reports, expert commentary, giving us that wide economic angle, but also the really close-up technical view.
Right. We're blending the fundamentals, the underlying drivers, with the short-term technicals. It's about seeing how the big narratives interact with those daily, sometimes hourly swings.
Okay, so let's dive in. This sudden kind of dramatic turn we saw recently, especially with altcoins. What's the immediate story the data tells us?
Well, the first thing that jumps out is a pretty broad sell-off across the market. Altcoins were definitely leading the way down, but, and this is where it gets interesting straight away, well, Bitcoin looked quite different, more resilient.
That divergence is key, isn't it? And when we say sell-off for the alts, we're not talking small numbers here, like Ethereum dropped 2%. Okay, notable. But Ripple's XRP, that was down over 10%.
Over 10%, yeah, which is a really substantial drop for a token that size. It definitely led the losses among the big players in that specific downturn. That really highlights the volatility even in established altcoins when sentiment shifts quickly.
And it wasn't just XRP, was it? This was more widespread.
Oh, absolutely. It wasn't isolated at all. You saw it across the board.
Our sources mentioned BNB, Solana, Cardano, even Dogecoin and Tron, all down more than 4%.
Exactly. BNB, SOL, ADA, Doge, Tron, the list goes on. It shows this wasn't about one specific project having problems. It was a sector-wide thing for altcoins.
Okay, here's where it gets really interesting. Like you said, all these alts are taking a hit, some pretty hard, and Bitcoin is just kind of steady, actually up a tiny bit, 0.26%.
Yeah, essentially holding its ground while everything else was falling.
What does that tell us right off the bat? Is it just a flight to safety within crypto
Yeah.
or something else?
It signals a definite shift in the market dynamics, and it's probably more nuanced than just a bad sign. Experts are pointing to a couple of things. One, that the altcoin rally maybe got a bit ahead of itself, sort of overheated momentum. And two, we're seeing signs of a necessary correction phase specifically for those alts. Altcoins often amplify market moves. They run up faster, but they can also fall harder. Higher risk, sometimes lower liquidity.
Like speedboats versus Bitcoin, the supertanker. Yeah.
Exactly. But, and this is really important, even with this sharp altcoin dip, the underlying fundamentals for the broader crypto market, they seem to be strengthening. That's a crucial point we need to explore because it stops this looking like just pure doom and gloom.
Right. So it's a recalibration, maybe, not a total collapse, a cool down in one area. So to really get why the alts corrected so sharply, we need to rewind a bit. Look at what pushed them up before this dip. Our sources mentioned James Harris. He's the CEO at Tesseract, an institutional crypto firm. Right?
That's him, deeply involved in bridging TradFi and crypto.
And he talked about a powerful trifecta of forces that fueled this huge rally, pushed the total market cap up to, what, $4 trillion?
An incredible $4 trillion peak. Yeah, understanding that massive run-up is essential context for the correction. Harris's trifecta gives us a great framework for those underlying strengths.
Okay, let's break down that trifecta. First leg, structural regulatory wins. Harris mentioned things like the Genius Act, progress on the Clarity Bill in the U.S. These aren't just minor details, are they? They seem to have genuinely shifted sentiment.
Yeah. Well, it's fascinating how concrete policy moves translate into market confidence, especially institutional confidence. Institutions bring the big money, the long-term capital, and they hate uncertainty. So the Genius Act, aiming to provide clear rules for stablecoins, and the Clarity Bill, trying to define if assets are securities or commodities. These efforts reduce ambiguity. They draw clearer lines. That makes institutions feel much safer about allocating serious capital. Harris called it a sharp turnaround in institutional sentiment, precisely because it lowers that perceived regulatory risk.
And the market reacted pretty much immediately, didn't it? Bitcoin jumped 10–15%.
It did, a significant jump. But what's really telling is what Harris noted about altcoins like Ethereum. They outpaced that growth.
Right. How much did they outpace it? And what does that suggest about where that institutional money was starting to look?
Well, the report suggests that while Bitcoin saw that 10–15%, some major alts like ETH saw gains closer to 20–25% in the same period. It really shows that as regulatory clarity improves, institutions feel more comfortable moving beyond just Bitcoin. They start looking at assets with different use cases, seeking potentially higher returns. It de-risks the broader altcoin space in their eyes.
Okay, so regulation is one major tailwind. But it's not just crypto-specific stuff, is it? Harris also pointed to the bigger economic picture, improving inflation, rate cut expectations.
Absolutely. That's the second leg of the trifecta, improving macro conditions. When central banks, like the Fed, signal a shift towards easing policy, lower interest rates, money gets cheaper. Suddenly, holding cash or low-yield bonds isn't very attractive. So capital starts looking for better returns.
And that flows into riskier assets, like crypto.
Exactly. Capital naturally flows into assets like crypto that sit higher on the risk curve. It's driven by that search for yield when traditional options look less appealing. It assumes the worst of inflation might be over, leading to a friendlier rate environment. Classic risk-on behavior.
Makes sense. Low returns elsewhere push money towards higher potential growth. And the third piece of Harris's trifecta. This one feels like a real sign of maturity, growing corporate treasury involvement. We're not just talking individuals or crypto funds now, but actual public companies putting crypto on their balance sheets.
Yeah, and this raises a really profound question. What does it signal when big corporations treat digital assets as treasury reserves? Not just speculation, but actual reserves. It's a huge shift in perception. It moves crypto towards the mainstream of corporate finance. Harris highlights this accelerating trend, companies diversifying, hedging inflation maybe, or just getting early exposure to a new asset class. It's strategic.
And the big example is strategy, right? MSTR, buying over 20,000 Bitcoin just this year. That's a massive commitment.
A huge commitment, yeah. Billions of dollars. And Harris says others are following.
Is it really others, though? Or is MSTR just an outlier?
No, definitely not an outlier anymore. MicroStrategy was the pioneer. Sure, they were very public about it. But Harris's research shows other listed firms are now buying ETH, SOL, other major alts. Sometimes quietly, sometimes they announce it. Imagine a tech firm buying ETH for dApp integration or a gaming company holding SOL. It's happening. And when a public company announces this, it sends a powerful validation signal. It legitimizes these assets beyond just Bitcoin.
Right, it moves them from new speculation to a potential treasury tool.
Precisely. It helps diversify corporate balance sheets away from just traditional finance.
And Harris called this whole corporate adoption thing a self-reinforcing loop. How does that work?
Well, think about it. One company does it publicly. That makes it seem less risky, more acceptable for the next company. It creates a precedent. Maybe a competitor follows suit, or firms in related industries. It snowballs. This increases confidence, attracts more institutional capital, not just crypto funds, but traditional managers, too. That deepens liquidity in the market. Deeper liquidity usually means less volatility over time. And lower volatility makes the assets even more attractive for corporate treasuries. See the loop? It accelerates mainstream adoption.
Okay, so we've painted this really strong picture. Regulatory clarity coming, favorable macro wins, corporations jumping in. Sounds almost unstoppable. But then Harris throws in that crucial warning. While momentum is strong, these forces can reverse quickly. Disciplined risk management remains essential.
And that's not just legal boilerplate. It's a critical reminder about markets, especially crypto. Things can change fast. A geopolitical event, bad economic data, a sudden regulatory shift. Sentiment can flip on a dime. The very things driving the rally, like capital chasing risk, can reverse just as quickly if the environment changes.
So the strong fundamentals don't guarantee a smooth ride.
Exactly. Long-term trend might be up, but the short-term path is bumpy. Ignoring risk is dangerous.
Which brings us right back to where we started. Despite those strong fundamentals, the market did see that sharp correction, especially in alts. This leads us perfectly into the near-term technical view from Alex Kuksikovic at FX Pro. He gives us the immediate, ground-level perspective.
Right. Kuksikovic provides that crucial counterpoint. He looks at the immediate action and says, point blank, altcoins, which had been fueling the rally, have sold off aggressively. This is basically the direct result, the manifestation of that overheated momentum Harris talked about. It's speculative positions unwinding fast.
And he really emphasized the scale, didn't he? Nearly half of the top 100 altcoins are posting double-digit losses. That's a lot.
It really underscores the severity for the altcoin space specifically. It wasn't a minor pullback for many of them. It was a serious repricing. And connecting it back, it suggests that while the long-term foundations might be getting stronger, the short-term moves, especially for alts, are driven by technicals and profit-taking. Traders see big, fast gains, momentum starts to wobble even slightly, and they rush to lock in profits. That creates a cascade.
The market hitting the brakes hard after speeding up.
Pretty much, yeah. A necessary, if painful, adjustment sometimes.
Okay, but amidst this altcoin carnage, Kupsevich really stressed Bitcoin's role. BTC's stability is critical. He even gave a specific number, $111,000. Said if Bitcoin drops to that level, it completes a textbook corrective pattern. What's the magic behind $111,000, and what's a textbook corrective pattern mean in plain English?
Well, $111,000 is likely a key level levis of analysts identify using technical tools, maybe a Fibonacci level, maybe prior support, maybe part of a known chart pattern. A textbook corrective pattern means the pullback, even if sharp, is following predictable technical signals, not just random chaos. Think of patterns like head and shoulders or waves in Elliott wave theory. It suggests the correction is, in a way, orderly shaking out froth, consolidating gains before potentially moving higher again. For technical traders, hitting that $111,000 might actually confirm the correction is playing out as expected, rather than signaling something fundamentally broken.
So Bitcoin's price isn't just its price, it's like a market-wide signal. Kupsevich warned continued weakness there could worsen bearish feelings everywhere.
Oh, absolutely. Bitcoin is the undisputed bellwether. Its stability gives psychological support. If it starts to seriously break down, confidence across the board can evaporate quickly. Even fundamentally strong altcoins could get dragged down further because overall market fear takes over. Bitcoin's strength often acts as that flight to quality anchor. Its weakness removes that anchor.
Institutions might pause. Liquidity could dry up. Yeah, I see how its stability is critical.
Exactly.
Now, one last really intriguing point from Kupsevich. This diverging investor sentiment between Bitcoin and Ethereum. He pointed out Bitcoin ETFs were seeing outflows recently, money leaving. But Ethereum funds, they were still attracting fresh capital during the same turbulent period. How does that work?
Yeah, that divergence is super interesting. Bitcoin ETF outflows could be several things. Profit taking after the big run, portfolio rebalancing, maybe some macro jitters making institutions trim risks slightly. But Ethereum continuing to pull in money even while other alts suffer. That suggests investors might see something different there, maybe more fundamentally driven confidence.
So what could that difference be? Is it about different stories, different uses?
Could be. Bitcoin is often framed as digital gold, store of value, inflation hedge. Maybe some who bought for that short-term trade are cycling out. Ethereum, though, is the foundation for so much more: DeFi, NFTs, dApps, Web3. It's programmable money, the internet of money. The inflows there might suggest investors are looking past short-term volatility and betting on its utility, its ecosystem growth, its long-term tech potential.
So different investment theses playing out even between the top two.
Exactly. One focused on scarcity and store of value, the other on utility, innovation, and network effects. It shows the market is maturing, differentiating between assets.
Okay, let's try to pull all these threads together. What does this tangled web actually mean for you, the listener, trying to navigate this? We've got Harris's big picture, strong long-term drivers like regulation, macro, corporate adoption, pushing things forward.
Okay.
But then Kupsevich's close-up view, sharp, technically driven corrections happening right now. How do we square that? It feels a bit contradictory.
It does, and that's the key challenge, isn't it? How do you reconcile strong long-term potential with scary short-term drops? The way to think about it is different forces working on different timelines. The long-term fundamentals, regulation, adoption, they're building the foundation. Those are structural shifts.
The bedrock, yeah.
Right. But the day-to-day, week-to-week stuff, that's driven by immediate sentiment, news reactions, technical levels, profit-taking cycles, especially in more volatile areas like altcoins.
So the short-term bumps don't necessarily negate the long-term journey.
Exactly. Corrections are normal, even healthy. They shake out speculation, allow consolidation. They can be triggered by momentum getting too hot or just hitting technical resistance. Understanding that interplay, the long-term macro pushing forward, the short-term micro causing volatility, that's how you get a complete picture. It's not one or the other. It's both happening at once.
Which really drives home why just knowing what happened isn't enough. You need the why. You need to know if it's a blip or a fundamental shift. And it shows why getting multiple perspectives, like Harris and Kupsevich, is so valuable. You need both the wide lens and the magnifying glass.
Absolutely essential. No single viewpoint captures it all. Harris gives us the fundamental why, the long-term tailwinds. Kupcikovic gives us the technical how, the immediate price action. Put them together, let them inform each other, and suddenly you have a much richer, more useful understanding, a better mental map for this complex territory.
Yeah, what really stands out to me after all this is just how complex the crypto market is. It's not one single thing. It's this mix of regulation, global economics, corporate strategy, and raw market mechanics. So for you listening, hopefully this deep dive gives you some solid takeaways.
Yeah, definitely. First takeaway, the market has strong underlying engines, but the road is bumpy. Expect corrections. They don't automatically mean the long-term story's broken.
Second, keep an eye on Bitcoin. It really is the market's compass. Its stability, or lack thereof, tells you a lot about overall sentiment and what might happen next with alts.
Third, sentiment isn't uniform. Investors can feel differently about Bitcoin versus Ethereum, for example, reflecting different use cases and investment ideas. The market is differentiating.
And finally, maybe the most important one, echoing both our experts, disciplined risk management. Even when the long-term outlook seems bright, don't ignore the short-term risks. Know your tolerance, manage your positions.
Those are really the key tools for navigating these waters with more clarity, more confidence.
Well, that wraps up another deep dive. It really is amazing how much clearer things become when you take the time to dig into different sources, different angles.
It really is. You start seeing the connections, the underlying logic behind the headlines.
So, as you think about all this, here's a final thought to chew on. Could these market corrections, these volatile periods, actually be good for the crypto ecosystem in the long run? Think about it. Maybe they weed out the weaker projects, the hype-driven stuff. Maybe they force real innovation and strengthen the foundations of the projects that survive and thrive. What kind of stronger, more resilient ecosystem might emerge from these periods of consolidation? It's something worth considering, building directly on what we've unpacked today.
That's a great question to ponder. Definitely food for thought as this space keeps evolving.